Hi, everyone. I'm Katie Stewart from Great Gray Trust Company, and I'm here to walk you through the fundamentals of collective investment trusts, or CITs, and why they're an increasingly important part of retirement plan investing. Let's start with Great Gray Trust and who our company is. We're a leading provider of CITs. We've led the way on transparency. Our predecessor was the first to list 700 searchable tickers through the NASDAQ Fund Network. We don't just provide CITs, we seek to provide value to all stakeholders in the retirement ecosystem, plan advisors, plan sponsors, and most importantly, plan participants through our fiduciary governance, transparency, technology, and ongoing education and thought leadership. Our in-house onboarding platform, Boarding Pass, streamlines the participation agreement onboarding process, and this is something we'll talk about more later. So what are CITs? CITs are pooled investment vehicles designed specifically for retirement plans. They've been around for decades and they offer a compelling alternative to mutual funds when it comes to cost, governance, and access. They're bank maintained and not registered with the SEC, which allows for certain efficiencies. Eligible plan types include pension, 401k, 401a, 457G government, 403b9 church. You can check out our website for frequent updates on 403b eligibility, as there is a big push for providing 403b plans access to CITs. Here's why CITs matter. The U.S. Department of Labor has made it clear that over a 35-year career, a 1% difference in fees and expenses can reduce a participant's retirement balance by 28%. Think about that. On a $1 million balance, that's $280,000 lost simply due to excess costs. CITs help close that gap, and according to Morningstar's 2023 Retirement Landscape Report, CITs are cheaper 88% of the time. The average active CIT costs 60% less than its mutual fund equivalent. Usually, reduced costs means sacrificing something else, and not in this case. CITs are regulated and governed in a way that offers robust investor protections specifically tailored for retirement plans. There are key differences between CITs and mutual funds. CITs were built for retirement plans. They're governed differently, priced differently, and operate under different legal frameworks. We'll cover this a little bit more later, but this distinction is essential. CITs are not retail products. They're purpose-built for institutional use. CITs have a long history and have evolved in response to regulatory, market, and fiduciary demands. They've been shaped by important legislation and infrastructure, including the Pension Protection Act, ERISA, and integration into platforms like the NSCC. The CIT market is growing. Target date funds assets crossed 3.7 trillion by the end of 2023, and CITs now hold a majority of those assets, 50.5% as of June 2024. That's a big inflection point after years of lagging mutual funds in perception. CITs are now leading the charge in real asset flow. You might ask yourself, why is this happening? There are three key drivers for CIT adoption. The first is governance and oversight. CITs benefit from a strong regulatory foundation across banking laws, securities laws, and ERISA. Second is fee flexibility and savings. Aggregating qualified assets drives pricing advantages. And thirdly, increased transparency. CIT data is now widely reported and tickers are available via NASDAQ. 82% of retirement plans now include CITs in their fund lineups. They've overtaken mutual funds as the dominant vehicle in target date strategies. That's not a future prediction. It's already happened. There are also legal considerations. In the Tibble versus Edison case, courts made it clear fiduciaries have a continuing duty to monitor investment costs and move to lower cost share classes when appropriate. CITs give fiduciaries a way to meet that duty, especially when they offer the same strategy at a lower price. CITs aren't just for the largest plans anymore. Minimum asset thresholds have come down or been eliminated in many cases, opening access to small and mid-sized plans. Transparency has improved. DOL regulations now require standardized investment disclosures for participants, regardless of vehicle type. That levels the playing field between mutual funds and CITs. Morningstar has been tracking CITs since 2007. Today, they report on over 7,800 CITs. CITs have tickers, they're listed. Participants get fact sheets. They see performance and fees just like they would with any mutual fund. Yes, CITs are influenced by 3 layers of regulation: state and federal banking laws, federal securities laws, and ERISA. This combination creates a governance structure that's both comprehensive and retirement focused. And our onboarding process is improving. CIT has traditionally been included a manual process that could be slower. That's changing, and at Great Gray, we offer both manual and automated onboarding paths for participation agreements. Both follow the same steps, the same governance, and we strongly recommend our Great Gray Boarding Pass automated path. Boarding Pass is our proprietary onboarding platform. It cuts the onboarding time dramatically. Instead of taking 7 to 10 days, we now can help advisors complete the participation agreement process in under 3 days when using Boarding Pass, which is our fully automated solution. That's a big win for advisors, record keepers, and plan sponsors alike. We offer many different CIT education resources. These are designed to answer the questions you may have about CITs. There's a CIT 101 guide, a breakdown of the trustee's role, and all of these materials help advisors, plan sponsors compare CITs to other vehicles. They're available on our website under our perspective section and also through our distribution team. In short, Great Gray is a trust company where we use our fiduciary heritage to propel innovation and CIT solutions. Great Gray is a place where innovation truly takes flight.